Imagine this. You work hard, save money every month, and you want that money to grow. But then you open the stock market and suddenly everything feels confusing. Stocks, index funds, mutual funds, expense ratios, risk, volatility. It feels like everyone else got the instruction manual except you. And that is exactly where most beginners stop. Not because they are lazy, not because they do not care, but because no one ever explained investing in a way that actually feels human.
Now here is the good news. There is one simple investment tool that millions of people around the world use to build wealth quietly, steadily, and without trying to guess the market every day. That tool is called an ETF. And by the end of this video, you will understand what an ETF is, how it works, why people buy it, what risks it has, and whether it makes sense for a beginner like you. No jargon, no confusion, just the real explanation, in plain English. Quick disclaimer before we begin. This video is made only to help you understand the basics of ETFs in a simple way. It is not financial advice. Please do your own research before investing, because all investments carry risk. Let me start with a small story. Imagine two people. The first person tries to pick individual stocks. They spend hours reading headlines, watching financial news, checking charts, and hoping to find the next big winner. Sometimes they get lucky. Sometimes they do not. And most of the time, they feel stressed. The second person takes a different path. They do not try to predict the next superstar company. Instead, they buy an ETF that gives them exposure to many companies at once. So instead of betting on one horse, they own a piece of the whole race. That second person may not feel exciting, but often, over time, they feel more consistent. And in personal finance, consistency matters a lot more than drama. That is why ETFs have become one of the most important tools for beginner investors. So what exactly is an ETF? ETF stands for Exchange Traded Fund. That sounds complicated, but the idea is actually very simple. An ETF is a basket of investments that you can buy and sell on the stock market, just like a normal stock. Think of it like a shopping basket. Inside that basket could be many different companies, or bonds, or commodities, or a mix of assets. When you buy one share of an ETF, you are not buying just one company. You are buying a small piece of everything inside that basket. That is why ETFs are often seen as an easy way to diversify. And diversification is just a fancy word for not putting all your money in one place. If one company falls, the whole basket does not necessarily collapse. That is one of the biggest reasons beginners like ETFs. Let us make this super practical. Suppose you want to invest in big US companies. Instead of buying Apple, Microsoft, Nvidia, Amazon, and Google one by one, you could buy an ETF that already includes many of them. Now, when you buy that ETF, you're indirectly getting exposure to all the companies inside it. This means one purchase can give you access to an entire market sector, country, or theme. That is why ETFs feel powerful. They simplify investing. They reduce the pressure of choosing the perfect stock. And for beginners, that can be a huge relief. Now, why do ETFs even exist? Because most people do not have the time, skill, or patience to study every company in the market. And honestly, even professionals struggle to beat the market consistently. That is why many investors prefer a simple strategy. Instead of trying to outsmart the market, they try to own a piece of it. That is the ETF mindset. Not, how do I find the one perfect stock, but how do I build wealth in a smarter, calmer way? This mindset has become especially popular in countries like the US, UK, Australia, and New Zealand, where many investors are looking for efficient, long-term investing options instead of constant speculation. Now let us compare ETFs with stocks. A stock represents ownership in one company. If you buy one share of Tesla, you own a tiny part of Tesla. If you buy one share of an ETF, you own a tiny part of many investments inside that fund. So a stock is like owning one tree. An ETF is like owning a part of a whole forest. That is the easiest way to remember it. With stocks, your result depends heavily on one company. With ETFs, your result is spread across many holdings. That does not mean ETFs always go up. It just means your risk is more spread out. And for many beginners, that feels safer and easier to manage. Here is what happens behind the scenes. A fund provider creates an ETF and decides what it will track. Some ETFs follow a broad market index. Some follow a sector like technology, healthcare, or energy. Some focus on bonds. Some focus on gold. Some focus on dividends. Once the ETF is created, it is listed on the stock exchange. That means you can buy or sell it during market hours, just like a stock. This is one of the reasons ETFs are so flexible. You are not locked into a complicated system. You can trade them easily. That is also where the word exchange traded comes from. A lot of beginners get confused between ETFs and index funds, so let us clear that up. An index fund is a fund that follows a market index. An ETF can also follow a market index. So in many cases, an ETF is an index fund, but not always. The real difference is that ETFs are traded on the stock exchange throughout the day, while some index funds are bought and sold differently, often once a day, depending on the structure. For a beginner, the practical takeaway is simple. Both can be low cost, diversified, and useful for long-term investing. The important part is not to obsess over the label. The important part is understanding what you own.
There are a few big reasons ETFs are so popular. First, they are simple. You do not need to study 50 companies before investing. Second, they are diversified. That reduces the danger of a single bad pick ruining everything. Third, many ETFs have lower fees compared to actively managed funds. That means more of your money stays invested instead of going to fund managers. Fourth, they are flexible. You can use them for retirement planning, long-term wealth building, or even short-term trading if that is your style. But for beginners, the most important reason is this. ETFs can make investing feel less scary. And when something feels less scary, people are more likely to stick with it. Think about what stops most people from investing. It is not always lack of money. Often, it is fear. Fear of losing money. Fear of making a stupid mistake. Fear of buying the wrong thing at the wrong time. That fear is real. And that is why an ETF can feel like a bridge. It does not promise instant riches. It does not make you feel like a genius. But it can give a beginner a clean, simple starting point. And sometimes, a simple starting point matters more than a perfect one. Because once people start investing, they begin learning with real experience instead of endless hesitation. Now let us go through the main types of ETFs in a beginner-friendly way. The first type is a broad market ETF. This is the most common type for long-term investors. It follows a large market index and gives you exposure to many companies at once. The second type is a sector ETF. This focuses on one industry, like technology, healthcare, banking, or energy. Sector ETFs can be exciting, but they can also be more volatile because they are concentrated in one area. The third type is a bond ETF. Instead of stocks, these hold bonds. They are often used by investors who want more stability or income. The fourth type is a commodity ETF. These may track things like gold or oil. The fifth type is a dividend ETF. These focus on companies that pay regular dividends, which can appeal to income-focused investors. The sixth type is a thematic ETF. These focus on trends like artificial intelligence, clean energy, or cybersecurity. Each ETF has a different purpose, and the right one depends on your goal, not on hype. How to choose one. So, how should a beginner choose an ETF? Start with your goal. Ask yourself, am I trying to grow money for the long term? Am I trying to reduce risk? Am I trying to get income? Am I trying to invest in a specific trend? Once your goal is clear, the rest becomes easier. Then look at what the ETF actually holds. Do not buy it just because the name sounds impressive. Check the underlying assets. Then look at the expense ratio. That is the annual fee charged by the fund. Lower fees are generally better because high fees can quietly eat away at returns over time. Also, look at liquidity. That simply means how easy it is to buy and sell the ETF without affecting the price too much. And finally, understand the risk. Every ETF has risk. Even a diversified ETF can fall if the overall market falls. There is no magic shield. One of the biggest mistakes beginners make is thinking an ETF is safe in the same way a bank account is safe. That is not true. An ETF can still lose value. If it tracks the stock market and the stock market drops, your ETF can drop too. So an ETF is not risk-free. It is just often less risky than betting on a single stock. That difference matters a lot, because if you misunderstand risk, you may panic sell at the worst time. And panic selling is one of the fastest ways to turn a good strategy into a bad result. ETFs are usually best for people who think long-term. That means years, not days. If you buy an ETF and then check it every 5 minutes, you may drive yourself crazy. Markets move up and down. That is normal. The goal is not to predict every move. The goal is to stay invested long enough for your money to potentially grow. This is where patience becomes part of the strategy. And patience is one of the hardest financial skills to learn. Let me tell you another simple story. A young beginner starts investing with small amounts. At first, they feel embarrassed because the amount is not huge. Maybe it's a few dollars each week or a small monthly investment. But they stay consistent. They invest regularly into a broad ETF. No drama, no panic, no chasing hot stocks. Months pass, then years, and slowly something changes. They stop seeing investing as gambling. They start seeing it as a habit. That shift is powerful because wealth is often not built by one lucky move. It is built by repeated small decisions over a long period of time. Now let us talk about fees because this part matters. Even a small fee can have a big effect over time. If an ETF charges more in fees, a bigger part of your return gets taken away. That is why low-cost ETFs are so attractive. It does not mean the cheapest ETF is always the best one, but it does mean you should pay attention. When you are investing for the long term, costs become very important. Think of fees like small leaks in a bucket. One leak may not look serious, but over time, too many leaks can drain a lot.
For many beginners, yes, ETFs can be a very good starting point. They are simple, they are flexible, they are easy to understand once the jargon is removed, and they let people build a diversified portfolio without needing to become a stock-picking expert. But they are not perfect for everyone. If someone wants to research individual companies and take more concentrated bets, they may prefer stocks. If someone wants guaranteed safety, an ETF may feel too risky because the value can still go down. So the right answer depends on the person. But for many people starting out, ETFs are one of the most practical entry points into investing. If you are brand new, here is the simplest way to think about it. First, learn what ETFs are. Second, understand what the ETF contains. Third, know the fees. Fourth, know your risk tolerance. Fifth, invest only money you do not need immediately. Sixth, stay consistent instead of reacting emotionally. That is the beginning of a strong investing habit. Not complicated, not flashy, just disciplined. Let us clear up a few myths. Myth 1, ETFs are always safe. False, they can still fall in value. Myth 2, ETFs guarantee profits. False, no investment guarantees profit. Myth 3, you need a lot of money to start. Not always true. Many people start small. Myth 4, ETFs are boring, so they are bad. Actually, boring can be very powerful in finance. A lot of wealth is built by boring habits repeated over time. Here is the truth. Most people do not need a complicated investment strategy. They need a clear one. They need something understandable, something they can stick with, something that helps them move from confusion to action. That is why ETFs matter. They give everyday people a simple way to take part in the market without feeling overwhelmed by it. And in a world full of financial noise, simplicity is not weak. Simplicity is strength. So if you are a beginner trying to learn investing from scratch, remember this. An ETF is just a basket of investments you can buy and sell like a stock. It helps you diversify. It can lower the pressure of picking single stocks. And for many people, it is one of the easiest ways to start building long-term wealth. The goal is not to become a trading genius overnight. The goal is to understand the game well enough to play it wisely. And now, you are one step closer to that.